Welcome to the Deep Dive. If you're anything like us, your desk is, well, it's covered in year-end reports and outlooks.
It's a mountain of paper.
It really is. And since it's the very last day of 2025, our mission is pretty simple. Cut through all that noise and distill what actually matters for the year ahead.
And it was an action-packed year. I mean, U.S. equities definitely rewarded investors.
No kidding. The S&P finished up about, what, 16%?
Around 16%, yeah. And you had the Dow, the NASDAQ, also locking in really strong double-digit gains for the year.
But looking at the sources, it feels like the story of late 2025 wasn't really about the indices themselves. It was about these two sort of huge undercurrents.
I completely agree. It's this fascinating dichotomy.
Exactly. On one hand, you have the formal, very planned end of the Warren Buffett era at Berkshire Hathaway.
A true institutional exit.
And then on the other hand, this chaotic, almost revolutionary surge into commodities that our sources are calling the Golden Renaissance.
It's a massive planned exit meeting, a huge systemic revolt against paper assets. It's pretty wild.
So where should we start? I guess with the institutional view, right, where most of the capital is still focused.
Yeah, let's start with the 2026 equity outlook. Because despite all the games we've already seen, Wall Street is surprisingly optimistic.
Okay, let's unpack that. I'm looking at the Morgan Stanley forecast, and their message seems really clear.
It is. They're basically saying, look, this bull market is definitely in its late cycle. Everyone gets that.
Right.
But, and this is the key, their models say the cycle is absolutely not over yet.
So they're betting on another year of positive returns. What's that based on?
Well, they lay out four, pretty powerful reasons. The first one is just pure historical precedent.
Okay.
They note that since the S&P 500 started back in 1950, whenever a bull market has lasted 4 years in a row, the fifth year has always been positive.
Always. That's a powerful stat. But what about now? I mean, with sovereign debt and inflation risks, do those old comparisons even hold up?
That's the big question, and they do acknowledge it. But they offset that risk with the next two pillars, monetary and fiscal help.
Accommodation.
Exactly. The second pillar is monetary policy. The base case is that the Fed will keep cutting rates through 2026. And historically, equities do very well when the Fed is easing.
And the third piece is that fiscal boost, the OBBA.
That's right, the Omnibus Budget Bill Authority. It's a major stimulus package that's projected to pump an estimated $170 billion of consumer aid into the system next year.
So that's real cash, providing a floor into the economy.
It's not just theory, yeah. It's measurable cash.
All right, so you have stimulus, you have rate cuts. That all sounds like a recipe for excitement, which makes their fourth pillar so counterintuitive. Cautious consumers.
I know, it sounds wrong, doesn't it?
It does. Why is a nervous consumer a good thing for stocks?
It's all about preventing the market from overheating. They lean on the University of Michigan Sentiment Index for this.
Okay.
And historically, market returns are actually healthiest when there's no, and this is their phrase, ebullience in spending.
So because the consumer is cautious right now, that's seen as a good thing.
A very good thing. It suggests measured, sustainable growth, not a speculative bubble about to pop. It's this idea that moderation is a sign of longevity.
Okay, so what about the risks? Specifically, the political calendar.
That's the big domestic hurdle. 2026 is a midterm election year.
Which usually means turbulence.
Yeah, the data is very clear on that. Since 1950, there's almost always a sizable correction during a midterm year, so that's kind of baked into expectations.
And this brings us to that central tension, the one adage you see in every single Wall Street report.
Bull markets don't die of old age.
They get killed by the Fed.
That's the ultimate kill switch. And when you look at the data, 6 of the last 11 bear markets, we're talking drops of 20% or more, were caused by one thing.
Inflation.
Uncontrolled inflation. It surges, forcing the Fed to get much more hawkish and hike rates, and that just pulls the rug out from under everything.
So as long as inflation stays in its box, the bull case holds.
That's the bet. But that inflation spike is the single biggest threat on the board.
Okay, let's shift a bit beyond just the Fed. The market has been so dominated by big tech and the AI narrative. Morgan Stanley actually addresses this AI obsession.
They do, and their take is fascinating. They argue that this constant debate about whether AI is a bubble is actually a good thing.
How so?
Because it's keeping valuations compressed everywhere else. Their whole thesis is that the AI rollout is still in the super early stages. The real economic impact, the huge productivity boost, is still ahead of us.
And if that boost happens, it gives the rest of the market a chance to catch up. This relates to the different indices, right?
Precisely. They're looking for the S&P 500 equal-weighted index to finally gain on the cap-weighted index.
Remind us of the difference there.
So the cap-weighted is what we always hear about. It's
Okay.
dominated by the biggest names, the Magnificent Seven. But the equal-weighted index gives the same importance to all 500 stocks.
So it's a better measure of the health of the whole economy.
Exactly. It's a bet on the other 493 companies finally having their moment, driven by that broad AI productivity.
That's a compelling thesis. So if we zoom out from the U.S., where should you, the listener, be looking for international opportunities?
The reports point to three main areas. First up, emerging markets.
Because of the dollar.
Yeah, that's the main catalyst. The U.S. dollar is expected to keep weakening after that 8 to 10% slide we saw in 2025. A cheaper dollar is a huge tailwind for emerging economies.
Okay, what's area number 2? I remember seeing Japan mentioned.
Yes, Japan is really catching investors' eyes. A lot of Japanese companies are finally aggressively embracing more shareholder-friendly policies.
Like buybacks and dividends.
Exactly. They're moving away from that old corporate complacency, and that's just fundamentally unlocking a lot of value.
And the third area was European banks.
Correct. They're just substantially cheaper than U.S. banks, and they're benefiting from a wave of deregulation that's very similar to what helped U.S. banks a few years ago.
So the institutional view is, let's say, cautiously optimistic, which means we need to bring in the voice of dissent.
We do, and it's a loud one. Michael Burry.
The big short investor himself.
He is ringing the alarm bell loud and clear. For 2026, he's predicting a massive earnings correction is on the horizon.
And he's putting his money where his mouth is, right?
He absolutely is. His latest filings show he's taken out significant bearish put positions against some of the biggest AI names like NVIDIA and Palantir Technologies.
He's basically drawing a straight line from the AI hype today back to the dot-com bubble in 2000.
A direct comparison.
Yep.
It tells you everything you need to know about his skepticism. And that philosophical divide, the institutional bet on the system holding up versus the fundamentalists' distrust, that is the defining tension right now.
And that word distrust brings us perfectly to the most explosive story of 2025, the golden renaissance.
I mean, this was a seismic shift, a massive transfer of wealth out of paper assets and into what the sources are calling hard money.
The numbers are just staggering. Gold gained, what, 70%?
Approximately 70% in 2025, hitting $4,561 an ounce. That is gold's strongest yearly performance since 1979.
A year famous for high inflation and, well, distrust in currencies.
And this wasn't just speculation. Central banks bought a record 1,100 tons of gold to protect their reserves.
But silver was the real story. It just exploded.
Silver was the true alpha. It surged over 150% to $82.40 an ounce.
So why did silver outperform gold by so much?
It's this dual-engine demand. It has its traditional role as money, sure, but it's also become absolutely critical for the modern economy.
For AI and green energy.
Exactly. You need it for high-efficiency solar panels and, get this, for the massive cooling systems inside AI data centers. That industrial demand created a huge supply deficit and drove global inventories to 20-year lows.
And there were a couple of key geopolitical events that threw fuel on this fire.
Two big ones. First, what the sources call the April breakout. A group of Global South nations started settling energy contracts using gold-backed instruments.
Bypassing the dollar.
Effectively, yeah. And then in the fall, you had the autumn tariff surge, which sparked fears of inflation, and gold jumped 15% in a single month.
And the miners, of course, were the huge beneficiaries.
Yep.
A name like Newmont was up 170%.
Their free cash flow was unbelievable, over $4.5 billion in Q3 alone. But here's the critical detail. They kept their all-in sustaining costs, their AISC, down near $1,500 an ounce.
So with gold over $4,500, their profit margin was just massive.
It's enormous. The AISC covers everything needed to run the mine, so keeping it that low with prices that high is just a license to print money. It really shows a pivot from a return on capital mindset to a return of capital one. People wanted safety.
And to contrast that safety, let's look back at Tesla, which is kind of the poster child for the skepticism Burry is talking about.
Yeah, as we said, Burry called it ridiculously overvalued. But he was careful to add he's not actually shorting it.
I know it.
He said the stock's volatility makes it a short's graveyard, and buying puts is just way too expensive.
And the company itself seemed to be trying to manage expectations down, didn't they?
They did something pretty unusual, yeah. They published their own company-compiled analyst estimates. That's usually a signal.
What do the numbers show?
They showed caution. The estimates point to Q4 deliveries being down about 15% year over year. And for the full year 2025, They're guiding to 1.64 million vehicles, which is actually down from 1.79 million in 2024.
A delivery hangover, I think they called it.
That's the term. Basically, a ton of people rushed to buy in Q3 to get expiring federal tax credits, and that pulled demand forward, creating a vacuum.
We've covered a lot of market moves, but 2025 also marked the end of a few eras. Let's start with a very orderly succession at Berkshire Hathaway.
Right. Warren Buffett, at age 95, officially transitioned the CEO role to Greg Abel at the end of the year.
Buffett is staying on as chairman, though.
He is, so his presence is still there,
Yeah.
but it's the formal handover of the top job after, 6 decades? It's incredible.
And alongside that, he sped up his philanthropic gifts.
Dramatically.
Yeah.
He converted a bunch of his A shares into B shares to give to his kids' foundations, and his reasoning was, I thought, really profound.
What did he say?
He noted that his children, who are in their late 60s and early 70s, are at their peak experience and wisdom right now to actually use that money effectively. He wanted to get it into their hands while they were best equipped to manage it.
I was also struck by his reflection on his Omaha roots.
Oh, yeah. He pointed out how all these key figures, Charlie Munger, Stan Lipsey, Don Keogh, were all from his immediate area. It really speaks to the culture he built.
It does. He also made a pretty sharp observation about CEO pay disclosure rules.
A classic Buffett insight. He said the rules, which were meant to moderate pay, completely backfired. They just created envy and drove compensation higher, not lower.
A classic case of unintended consequences. So that's the planned, dignified exit. Now let's contrast it with the complete opposite. The sudden collapse of Sprinkles Cupcakes.
What a story. A total rapid collapse. The entire chain reportedly shut down all U.S. locations on December 31st. Immediately.
And the employees got almost no notice.
24 hours notice and no severance. It was brutal. And it's just a perfect microcosm of the pressures on some businesses right now.
You had the cupcake craze failing, their high-rent locations, and then this massive surge in local labor costs.
A 70% surge. From around $10 an hour pre-COVID to about $17 now. For a business built on novelty, that's just unsustainable.
And there's a theory that it was a private equity move, right?
A strong theory. Carp Riley invested back in 2013. The timing suggests they might have just been cutting their losses once the initial long-term leases were up, leaving everyone else to deal with the fallout.
Okay, finally, let's cap off the year with the gift that keeps on not giving. The Trump Mobile T1 phone.
Another delay. The $499 gold phone missed the entire 2025 year. The launch is now pushed to mid or late January 2026.
And the excuse this time?
Customer service reps are blaming the U.S. government shutdown from October and November. They claim it paused the FCC approval process. And for what it's worth, the advertised specs are a 6.25-inch AMOLED display, Android 15, and 256 gigs of storage, if it ever arrives.
So let's synthesize all of this for you, the listener, heading into 2026. We started with the institutional view, which is still betting on the system.
Right. They're positive on equities. They're citing the Fed. They're citing stimulus. They see the rally broadening out.
And yet, the most explosive moves of the year were in gold and silver, in assets representing a return of capital.
Which signals a deep fundamental distrust in debt and fiat currency. And we saw both planned exits like Buffett's and sudden failures like Sprinkles. It just shows how fragile things can be.
So as we head into a new year, where the bull case depends so heavily on the Fed and where someone like Michael Burry is questioning tech valuations, the key question for you to think about is this.
Was the golden renaissance of 2025 just a temporary flight to safety, or was it a real structural shift?
A shift toward prioritizing intrinsic physical value over speculative paper assets. It's really a fundamental question of trust in the system itself.
And the answer to that question is going to define your portfolio for the next decade.
And that is your deep dive into the close of 2025. We'll talk to you next year.